Hello, everyone, and welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to get everyone an update on the commercial real estate market. So before we get into me sharing a couple articles with you, I just wanted to give everyone a couple of headlines. So I'm around the Philadelphia market, as it were, and I just wanted to give everybody a quick glimpse into what is kind of happening here on the Philadelphia scene. Because I think it's very relevant to I think you're seeing a lot of the same patterns to what is happening in other major office markets around the U.S. So here in Philadelphia, 1818 Market Street faces imminent default as Center City Office Building's owner seeks to renegotiate $223 million loan. 2023 year in review. Center City office buildings are in financial distress and the fallout is likely to continue. Rampant office downsizing in Center City led to record vacancy rates this year. Expect more of the same in 2022. So in the past year, Philadelphia companies signing new leases generally downsized their office space by between 20 and 40%. It's a trend likely to continue as remote and hybrid work policies become entrenched in many white-collar professions. And then finally, we had a real estate investment trust locally here called PREIT. They filed for Chapter 11 bankruptcy. And they agreed to relinquish a stake in what's called the Fashion District down in Center City, Philadelphia. So not a great time to be in the office market here in Philadelphia. A lot of this episode today, we're going to be talking mainly on the office market, but I did want to touch a little bit on some of the other sectors as we go along here. But first, I just want to share a couple articles here with everyone. So first article here. So this is from S&P Capital IQ. So this is the U.S. office market report, which basically says that there are higher rates and lower valuations spur fierce headwinds. Now, this article is attributed mainly to REITs and the performance of REITs that are invested in the office market sector. So let's read the main headline here. So investors remain skeptical of the office market and continue to trade office REITs at vast discounts to their net asset value estimates. Similarly, low valuations have pushed the median implied capitalization rate for the office REIT sector to its highest level in more than 20 years. Price discovery remains limited, with office transaction volume down more than 60% in most major markets. Banks are preparing for tough sledding, having built reserves to high single-digit percentages on loans tied to office properties. And I want to just go down here to this one chart here, so this shows the chart we're looking at here is of office REIT median implied capitalization rates. So if anybody doesn't know anything about cap rates go inverse of property value. So in other words, a normal cap rate might be 8%. If the market is really hot, like we've been at times the last 5-6 years, cap rates could be as low as 4%. But probably more like the 5 to 6% range. In a bad market or in bad times, you might see cap rates as high as like 10, 11, 12%. And that's basically what you're seeing here in this red line. So, you can see here, probably around 2018, 2019, this was riding at about 6.5%. And now it's cruised all the way up to probably about 11.5% here by the end of 2023. So going from 6.5 to 11.5 cap rate, that's a pretty dramatic increase in cap rate, meaning you're seeing a dramatic decrease in property values. And again, just down here, basically, sharp increases in interest rates over the last 18 months have sparked concerns in the investment community that banks will see their commercial real estate loan portfolios come under stress. Yes, they will. Delinquency rates tied to commercial real estate credits increased in recent quarters, albeit off low bases. And then down here at the bottom, there's basically a chart looking at some of the different sectors in commercial real estate, like commercial real estate loans, C&D loans, which is construction and development, multifamily, non-owner occupied, and then it goes into the delinquency rate itself. So you can see here by the red line on the graph that delinquency rate has, again, from the third quarter of 2022, last 5 quarters, that delinquency rate has spiked up. So that's basically the trend of what you're seeing at the moment. So let's go to another article here. So this is distress in commercial real estate loans on non-owner occupied properties rises at U.S. banks. So for people who aren't aware, yes, there are four main sectors to commercial real estate, but banks will basically break those up into two main buckets, which is owner-occupied properties and non-owner occupied properties. An owner-occupied property would be a situation like this. Say you have a law firm. That law firm's owned by three partners. They go buy an office building, and then their law firm occupies the office building. So in other words, the same people that own the underlying business that occupy the space also own the building. That's what thus making it an owner-occupied property. A non-owner occupied property is a strictly investment property. You're just renting that. You're the owner and you just rent that out to other tenants. So so what they're saying here is that the delinquency rate on the non-owner occupied properties is beginning to spike. And that makes sense because there's kind of different sides to the real estate market. Like you have I would say properties under, say, $10 million, which gets financed by a lot of the smaller banks out there. And then you've got the loans of, that get into the 15 to 50 million or 100 million plus that get financed by the bigger banks out there. A lot of those loans are what you call non-recourse loans, meaning that they're probably like investment grade, large scale. It could be institutional buyers. So you're not going to have anybody that's going to personally guarantee those loans. So when the loan goes bad, there's a higher probability that they're just going to hand the keys back to the bank. And that's kind of something in that somewhat requires a little bit deeper. That's a somewhat oversimplification on my part, but it's still, I think you kind of get the point there. And let's see here. And then down here, we have a commercial real estate loan breakdown by type, assets, and region. The one thing I would point out on this chart, a couple interesting things here. So greater than 100 billion. And you can see here, there's $527 billion in commercial real estate greater than 100 billion. The non-owner occupied makes up about 67% of that. You've seen that the quarterly change in BIPS is 101, which is big, and then the non-owner occupied versus owner occupied. I'm sorry, non-owner occupied commercial real estate NCOs versus non-owner occupied real estate loans minus 53 basis points. So what I'm trying to point out there is that there's a swing there amongst the higher end properties, the larger properties. And then just to point out, the area that has the highest concentration is the Northeast section of the United States, which has got about 156 billion. About 68% are considered non-owner occupied properties. But then as you come down here to this chart gets really interesting. So top U.S. banks by the highest non-owner occupied commercial real estate concentrations as far as the third quarter of 2023. And the big banks on here have a huge concentration in non-owner occupied properties. You got Morgan Stanley has 97% of their commercial real estate portfolio is non-owner occupied properties. Goldman Sachs Group, 97%. Citigroup, 90%. Capital One, 90%. Bank of OZK, 87%. Western Alliance Bank, 84%. Wells Fargo, 79%. I mean, these are massive percentages for these bigger banks. And now look at the underlying delinquency. Morgan Stanley. Now, here's an interesting thing. You might look at that 1.71%, and that might not seem very big, but that's actually pretty big. And then because normally you want to see a delinquency rate, say below 1%, that's where you want to be. Kind of like, you see a lot of the banks down here on the list, like 0.27, 0.28, 0.25, 0.24, even 0.94. Like that's kind of more the range that you want to be in. But then you see Goldman Sachs here, 17.26% delinquency. That is a massive, massive amount of delinquency. And I'm going to kind of explain what some of these banks are doing here with they are currently trying to offload a lot of these loans right now. And I'm going to get into that in another episode, kind of explaining that in a little bit more depth of how they're trying to deal with this onslaught of delinquency that they know is coming. Let's go to another article here. So office commercial real estate downturn is only in the beginning stages, Wells Fargo CFO. So the San Francisco-based company's net charge-offs increased 17 basis points during the quarter, bringing its total net charge-offs to 53 basis points. Losses started to materialize in our commercial real estate office portfolio as market fundamentals remain weak. The losses were across a number of loans spread across various markets and were driven by borrower performance, lower appraisals, or loans being sold at a loss. The company began preparing for a downturn in office commercial real estate credit quality by steadily building reserves throughout 2023. I do think that we've got a while for this to play out through the system. Institutional style office buildings are seeing more stress. In other words, larger office buildings in metropolitan markets. Let's see here. And then here was an interesting thing. So the FDIC put out this report on December 18th. They put out, so this was advisory managing commercial real estate concentrations in a challenging economic environment. And they basically, so some of the recommendations they make here are, maintain strong capital levels, ensure that credit loss allowances are appropriate. In other words, your what's called your loan loss reserves, manage construction and development, C&D and CRE loan portfolios closely, maintain updated financial and analytical information, bolster the loan workout infrastructure, and maintain adequate liquidity and diverse funding sources. So if anybody saw my episode on loan workouts, you might want to go back and check that out, because one of the things that they're saying in this report is that they think that, banks should basically beef up on their loan workout areas. They should hire more loan workout people. The problem with that is that we haven't had, it's been about 15 years since the banking industry had a massive kind of implosion in real estate where they had to have a lot of workout people on hand to deal with a lot of this stuff. So you don't have an overabundance of workout people that are hanging around right now. That's kind of the problem. Banks are really going to have to work at this, especially the bigger banks, as these things start to pile up. And I have a feeling that a lot of people who have never had any experience at workout are about to get a whole lot of experience at workout. So what I want to do for a second, we'll come back to the office in just a second. I just wanted to touch on some of the other areas. So in the commercial the commercial apartment market, like Philadelphia, for example, like Philadelphia is about to get flooded with, Philadelphia's in the middle of a historic surge in multifamily development with more than 13,000 units under construction, according to CoStar. That's a lot. That's a lot of units. I mean, basically over the last couple of years, we went into this just absolutely building splurge, just, building all these properties, and the market's going to have to, digest that. And then basically this other article goes on to say, rental market deceleration foreshadows 2024 multifamily operators. The multifamily market has been cooling since its white hot streak of growth in 2021 and the first half of 2022. But while some U.S. apartment markets have seen rental declines, owing primarily to a lot of new supply hitting the market, and there are palpable concerns about multifamily loan maturities, there also are indications of competitiveness for the multifamily market in certain cities for the year ahead. So there's no doubt that the rent increases have dramatically slowed. I mean, you're not going to get those 10, 20, 30% rent increases that landlords were getting for a couple of years here. I mean, I think the apartment market has really stabilized and things have really pulled back at this point. And you're going to see a lot more competition for apartment units because again, that 13,000 units, that's just the Philly market. That's not New York, Washington, Boston, Baltimore, all these other areas up and down the East Coast, which probably, if I looked at CoStar, probably have very similar numbers. They probably have anything from 10 to 20,000 units, probably all coming online in all of those cities up and down the Eastern Seaboard, I would imagine. So, that's a tremendous amount of product that's coming into the market in a short period of time, and the market is going to have some struggles digesting all that. So we'll have to see how that all plays out. Retail market, I think, continues to be very hit or miss. Some properties are really good, some properties are not so much. It all depends on the kind of your anchor tenants and the type of property it is. Is it a mall? Is it like an outdoor outlet? Is it like a retail strip center? What is it? How big is it? What are your credit tenants? All that stuff really matters when it comes to retail. Industrial, I think industrial has a lot of the same issues that the multifamily market has. In other words, they've got a lot of supply coming online, which is beginning to drive up vacancy a little bit there, and it's also stalling out rent increases the same exact way that we're seeing that in the multifamily market. So again, I think it's like multifamily and industrial and retail are all like kind of like yellow light, like caution, like just like nothing to worry about just yet, but you need to keep an eye on this. Office market, office market's in big trouble. You've just, especially the bigger office buildings in these larger metropolitan cities, where a lot of people are just not going into work. Now, the one issue that I have to point out that I feel like never gets mentioned in these articles, and that is the crime in these cities. The crime has become a major problem in, I think, pretty much every major city across the United States. And that's something that these cities need to tackle. I found it, interesting that, Philadelphia just elected a new mayor, and what we call the center city business district just got a new CEO, and both of them came out. Their number one priority was crime and safety. That both of them came right out of the gate. Number one thing, crime and safety. So they know it's there. Like they know it's there. They know it's a big issue. They know it has to be dealt with. And I think that's something that needs to go in, because again, the issue is not as simple as people not wanting to come back to the office. It is a little bit more complicated, that with the crime and, like I said, with some of the other issues that are going on right now in these major cities. So and interest rates are not helping with this, but the bottom line is the rent rolls are down, meaning the valuations are down, the appraised values are going to come in lower. These properties are going to be sold a lot less than what the current mortgages are they have outstanding. There's going to be a lot of delinquency. There's going to be a lot of runoff, and this is something that's going to play out over the next 2-3 years. It's not going to be like a quick thing that happens in a couple months and then it's over with. So I hope, everybody enjoyed that or got a little knowledge on that as far as what's happening in the commercial real estate market. And I'll come back probably in another 3 months, 4 months, and do another update on the commercial real estate market and see what's going on there. Keep an eye out. I've got a bunch of kind of a flurry of episodes that I'm coming out here with this weekend to hopefully hit people with some good stuff over the MLK holiday here. And so just keep an eye out for things. Like I said, a bunch of I got a new interview coming out. I got a couple other episodes on update on mergers and acquisitions, just a general update on the banking market. So a number of different things coming out, but check that out. Please make sure to give a thumbs up, make sure to like and subscribe, leave a comment below. I always love getting back to people, and make sure to follow us on YouTube, Rumble, and all major podcast platforms. And I'll be back and talk to everybody again real soon. Thanks a lot.